Individual retirement accounts are a cornerstone of the retirement planning section on the national portion of your life insurance exam. The distinction between traditional and Roth IRAs is one of the most frequently tested concepts, and the exam expects you to identify which one provides an immediate tax benefit versus a long-term one. A traditional IRA is often referred to as a tax-deferred vehicle. This means that if you have earned income, you can put money into the account and potentially deduct that amount from your taxable income for the year. However, the catch is that every dollar you withdraw during retirement will be taxed as ordinary income. The exam will often present a scenario where a client wants to lower their current tax bill, and the answer will almost always point toward the traditional IRA. In contrast, the Roth IRA is funded with after-tax dollars. There is no immediate tax deduction, but the growth and the withdrawals are completely tax-free if the distribution is qualified. To be considered qualified, the account must have been held for 5 years and the individual must be at least 59 and a half, or the funds must be used for death, disability, or a first-time home purchase, up to a $10,000 lifetime limit. Be very careful with the wording on the exam regarding contribution limits. For the 2025 tax year, the limit is $7,000, and if the individual is age 50 or older, they can add an extra $1,000 as a catch-up contribution. A favorite trick of exam writers is to ask if a person can contribute to both a traditional and a Roth IRA. The answer is yes, but their total combined contribution cannot exceed that $7,000 limit. You also need to know that traditional IRAs have required minimum distributions, which currently begin at age 73. If the owner fails to take these distributions, they face a significant tax penalty. Roth IRAs, however, do not require the original owner to take distributions at any age. This makes the Roth a powerful tool for wealth transfer. Another point of confusion on the exam is the eligibility for these accounts. Anyone with earned income, like wages or salary, can contribute to a traditional IRA, regardless of how much they make, though their ability to deduct those contributions might be limited if they have a retirement plan at work. Roth IRAs are different because they have strict income eligibility limits. If you make too much money, you are legally barred from contributing directly to a Roth IRA. To keep these straight, remember the phrase, traditional is taxed later and Roth is retired tax-free. This simple mental shortcut will help you navigate questions about when the IRS takes its cut. Finally, remember the 10% premature withdrawal penalty. If a client takes money out before 59 and a half, they generally owe that 10% penalty, in addition to ordinary income tax on traditional IRA distributions. The exam may ask about exceptions to this penalty, such as using the money for qualifying higher education expenses or health insurance premiums while unemployed. Earned income includes things like bonuses and commissions, but specifically excludes passive income like rental income interest or dividends. If you see a question about a non-working spouse, remember the spousal IRA rule, which allows a working spouse to contribute to an account for a non-working spouse as long as they have enough earned income to cover both contributions. This is a common way the exam tests your knowledge of contribution eligibility and ensures you understand that the account is always individual and never joint, even if the funding comes from a spouse. Mastering these specific differences in taxation limits and withdrawal rules is the key to passing this section of the National Life Insurance Exam.